Hey everyone, Eddie Wilson here with the Think Realty Video Podcast. So excited to be the host for today. Usually Abhi Golhar is the host, but with these crazy circumstances in the country, everything has changed. And as the founder and owner of Think Realty, I get the exciting opportunity to sit in here and interview some amazing people today. And so today is no exception. I've got a good friend of mine that's going to be joining us here in just a second. But I first want to say thank you to our podcast sponsor. Our podcast sponsor is Clint Coons from Anderson Business Advisors. They're a nationally recognized group for providing bulletproof asset protection. They're an asset protection group. They help you with tax and business strategy advice if you're a real estate investor. You can go to getbulletprooftoday.com and you can get Clint's free book, which is called Asset Protection for Real Estate Investors. Great book. I've read it myself. And he'll actually provide that for free while supplies last. And you can go to getbulletprooftoday.com to get that free book. Thank you so much to Anderson Business Advisors for their support of the podcast. Today's guest is James Kandasamy. James is a multifamily investor, a good friend of mine. I've actually been down to Austin where he invests, and we've sat down and had lots of conversations about strategy and various other things, and I'm excited to talk to him today. James, are you with us today?
Yeah, absolutely. Hey, Eddie.
Hey, James.
Nice to be on your show.
Yeah, so are you in Austin, Texas today? Is that what's behind you?
Yeah, I'm in Austin, Texas doing the shelter in-house due to this COVID-19. So
yeah.
Everybody's getting used to the new norm, I guess.
The new normal, I don't ever want to get used to. I'm so
temporary. Hopefully all this is temporary.
I'm so stir crazy. I have such wanderlust. I'm ready to just go travel the world.
Yeah, I know. It's crazy out here, right? So
it is crazy. So James, as a multifamily investor, tell us a little bit about your business and your business model. Obviously I know a lot about your business, but I want our viewers to understand and have context for what we talk about next. So if you don't mind, just spend a minute or two and talk to us about your business.
Sure. So I'm a multifamily syndicator where we raise money from high net worth individuals or family offices to go and buy apartment buildings, right? And then we basically, make it less as an investment and give a return to all our passive investors. So we own right now almost $130 million in assets across 9 multifamily properties, almost 1,700 units. And we are primarily focused in San Antonio and Austin, which is an awesome market in Central Texas. And we are also a vertically integrated company, which means we own asset management, property management, and construction management. So we do end-to-end, right? So that gives us a lot of control over the deals that we do, which is usually what we call as a value add where we buy a deal and we add value to the deal to increase the income and eventually increasing the valuation of that asset.
That's great. And so not only that, you also provide a lot of great investment opportunity or content and things like that to investors. You have a podcast, and I know a platform for real estate investors to learn. And so I appreciate all that you do there. So
absolutely.
The multifamily industry, I've heard a lot of, I'm a passive investor in some multifamily syndications, and I've heard both sides, right? Like the sky is falling, our businesses are falling apart, and then I've heard this is going to be the greatest opportunity that we've seen in our lifetime. And obviously, we need to be cognizant and careful of the fact that there are people's health issues at risk, and I want to be cognizant of the suffering that people are going through. But as an investor, where do you sit? I mean, do you think there's great opportunity to come, or do you think the multifamily sector is in trouble?
I think so. For now, if you look at it right now, right, we are in April right now, and I think the multifamily industry has not presented any deals yet because all this happened so quickly. So the sellers have not brought down their prices. There's not many sellers out there who are selling like at 30-40% discount from what it used to be like 1 month ago or 2 months ago, right? So a lot of times they are just selling at the lower range of their BOV, broker price opinion, right? So I don't think so the deal is manifest itself yet, but could be in the next 3 to 6 months. You probably will see some deals popping out. People who have burned through their reserve because renters are not paying right now. Not saying renters are not paying; they're paying less, so the delinquency is high. They don't have reserves, and these are the people that were already in trouble going into this COVID-19 recession, I would call it, right? So if they're already in trouble before this, and they are just going to be under a lot of panic mode right now, trying to burn through their reserve, or maybe they don't have reserve right now, right? So, and it depends on where they are located, what class are we talking about, right? Which submarket, and uh, what submarket they are in, because some submarket has diversity of jobs, but some submarket depending a lot on the service industry, right? So it depends on which class and which submarket that we're going to see some opportunities popping out soon.
Sure. Yeah, I've heard a lot of disparity. Some saying, "Oh, I've collected 100% of my rents." I've heard I've heard big properties saying we've only collected 40 to 50% of our rents. And from my experience so far, it seems like April is okay. It seems like May actually might be the difficult month. It really depends on if the stimulus money hits the general marketplace. Are they going to get their checks? Then does it push, those rent delinquencies maybe to June? And then, hopefully by June, this virus begins to go away. We can get out of our house. Who knows how all this plays out? You and I have talked a lot about the past few years, a lot of people getting into multifamily, and their deals are too thin. The margins are too thin. Their cap rates are less than what they expected. Do you believe those are the distressed assets? They're going to come back on the market quickest? The ones that maybe over the past year or two or three were maybe purchased in haste and the margins were too thin?
There's few factors that you're going to see in terms of manifestation of good deals or people under distress. One is people with low reserve. The other one is people would have bought it, a few years back, but if they are still in IO period, interest only, they might be okay. But there are a lot of people who have bought deals 3 or 4 years ago and got a IO payment option for 3 or 4 years. So if they're expiring right now, they're going to go negative because of the principal kicking in, right? And lenders have not offered that option until now. They've given forbearance, but a lot of multifamily owners that I know is not even looking at forbearance right now. They're really trying to ride this through without forbearance, unless that's the last option, right? They're going to do that, right? So, yeah, I mean, there are a lot of people who bought deals assuming there's a 3% rent growth. But that rent growth is not going to be there for maybe at least 1 year, right? So that are the people. Either it depends on how bad is the situation gets, and depends on the loan type that they have. So if they have that long-term fixed rate loan with Fannie and Freddie, there's a lot of options. Government's trying to help out a lot of ways, but there's a lot of CMBS loans out there, or even a bridge lenders, right? Which is could be, and I don't think so they have a forbearance option, or they're asking for a lot of money to get forbearance option, right? And maybe there are lenders out there who are just trying to take property for the for lower price right now, right? So that could be some of the deals that having issues suffering through this COVID-19 crisis.
Sure. James, I don't know if you've seen it the way I've seen it. I own both Think Realty and the American Association of Private Lenders, and talking to hundreds of lenders over the past couple of weeks, it's apparent to me that kind of the top part of the lending, stack, like you've got the conventional loans that were, conventional type lenders that were really dependent on the capital markets that have dried up, like they've gone away. And then you have all the self-directed IRA type investor, lenders that are lending out of their IRAs. They're terrified. They're scared. And so a lot of them have gone away, But I've seen the center section, which is people that have raised capital in discretionary funds. They seem to be more aggressive right now. So, one thing that I was talking to a multifamily lender or a multifamily investor the other day about is this might be the period of time where you have to use a bridge loan in your strategy that maybe you weren't considering before, because that middle tier with people with discretionary funds, they're going to lend it, maybe a lesser LTV now. Their terms have changed. Maybe they've added 100 basis points or something like that to the loan. But they may actually stretch you out and get you into a place where, if you're in the middle of a deal, if you're looking for acquisitions, where you can get back to conventional lending, and when those capital markets come back again strong after a lot of these issues dry up, that might be an option as well. Do you see kind of the same thing?
That could be an option. I do not know much details about the lenders spectrum, right? But there could be cases where people are taking advantage just because they have raised a discretionary fund, before this, right? But I do think there's a lot of opportunity if people are able to structure things creatively, right? For example, if a lender is coming and giving option to buy out some shares of investors at a discounted rate. So let's say you have 100 passive investor in a deal, and now let's say a lender comes and say, hey, I can buy some of your share at a lower price, and anybody want to get out or not? So that could be one option, right? Rather than buying the entire deal, but they can buy a share in a syndicated deal, right? So second is if they find someone who can do creative purchases, such as someone who's willing to buy deals or found a deal which can be closed with the master lease, right? If they can help that guy support master lease and negotiate a price to refi, that could be a way as well to do that. And of course, buying it outright is always an option, but I just don't think the opportunity has existed until right now, right? I think it's going to take another couple of months for you to see the stress coming out from the marketplace.
Because your company is vertically integrated, would you have any suggestions or advice to those that are maybe self-managing their properties? You have a property management company. Anything that you've done that you've seen work, this past month? Any suggestions that maybe you would give to those that do manage properties? I know you manage 1,800 properties, so you must have seen some things over the past month or two that have worked and maybe haven't worked. What are your thoughts?
Absolutely. So let me give you a breakdown on where we are in terms of collections, right? Because I know you talked about collections, but I want to give you some breakdown. So we track a KPI called the COVID-19 KPI, right? Which has never existed before this. So how fast our delinquency is being collected. So we track our delinquency on a daily basis, even before all this happens, right? So to see where we are in terms of delinquency, to give motivation to our property managers and collectors, which is assistant managers, to go and collect the money. So now we lay out that indicator to see the burn down of a monthly on a daily chart on where it's happening. Now because of this COVID-19, now people can stay in their unit, but they may not be paying, right? So now we're putting another chart on top of the past few months, past month collection versus now, where are we right now? So we are seeing roughly, most residents are paying like 1 month late, well, not say 1 month, 1 week late compared to what they used to pay, just because right now there's no penalty. We pay for late fees, and they know there's no pressure, right? They can't be kicked out of their apartments, right? So it seems to be 1 week, but we are collecting. There are some properties which is, there's more divergence in terms of what we used to collect compared to what we're collecting right now. So that could be just because the managers didn't communicate to the residents that they still have to pay rent. So we are working on it, but most of it there is basically a similar burn down chart, even though it's a 1 week gap, right? And we are seeing the flattening of that delinquency happening much more later compared to what we used to be. So now we are working on going back to the residents and getting back the collections. So these are things that one of the things that we are doing as a property management company as well, and it's just so effective for us to do this ourselves because we're vertically integrated, and we're able to streamline all our communication with our property managers and to the residents. So basically, some of the things we did is we have Q&A documents which outlines how one should respond when certain questions is being asked. So we try to standardize across all our staff. We also have a a standard document that we give to the resident to say that, where can they go and get assistance, and also that, with the outline saying that the rent is still due, you still have to pay rent, uh, so these are some of the things we are doing on top of like closing the amenities and making sure we're only doing the emergency work orders, closing the office, to the public, but we still do tours and all that. So we are still leasing. Amazingly, we're still doing a lot of leases. Our average unit on the market right now is less than 10 days. Every time a unit is ready, it gets leased up. So
Wow.
we're still doing a lot of leasing. It's happening. And I can see that on a real time. In fact, every morning now I'm seeing who's paying the rent every day. So I can see people are still paying money. And people who are not paying, we're also going back to them and asking them, hey, how can we help you to pay this, right? Is there a payment plan? And you'll be surprised on how much assistance we're getting, not only from the government, which is the big money, that the $2 trillion stimulus. It's a lot of local city councils that's helping out as well. Like, for example, city of San Antonio rolled out a program where they said, the city is going to pay the rent, but they want us to forgive 25% of the rents, right? So they pay 70%, which is awesome, right? So for people who really cannot pay, cannot get unemployment, and it's already under evictions or just cannot pay at all, we stay in your units, go and get this program, right? Which means we still get 75%. So I'm not sure how much budget they have, but we're going to try that, right? And City of Austin, they have a lot of programs. It's a lot of charity organization out here trying to help out. So we are reaching out to all of them, and so it's a lot of work for us. But since we are vertically integrated, we are able to do all that very quickly. So like we have a big spreadsheet tracking who has on a payment plan, who's getting help from where, and we have a laundry list of things that we can go and ask each of this organization to help out, right? And so we have dedicated 2 people. One is for the south, one is for the north region, trying to like just pound on collections, because we need all the money to come, and there's a lot of support out there as well, provided you're in the right location and the right sub market.
Yeah, that's great. A lot of good advice there. And if you are a landlord watching, the big point that James was making is be proactive. Just don't wait for your rent to just come in and then react. Like be proactive. He talked about those checklists that he had and all the things that he could offer to the tenant that maybe is struggling to pay their rent. So it's really, really good advice. James,
and one thing I want to add is there's no real there's less than 5% of the residents saying that I'm not paying. Everybody says I will pay. I mean, either they already paid, or whoever could not pay, they said, okay, I'm going to pay on this date, I'm going to pay on the other date. There's 2 dates that's been given to us. We don't have to really stretch it out for 12 months, like what the payment plan that has been advised by the Texas Apartment Association. So hopefully things stay the same for next few months, which is going to come. And after that, hopefully the economy picks up and we're back to at least to some level of normalcy.
Sure. Yeah, very good. Well, thank you so much for your time today. How can our viewers watch you? I know you provide a lot of great content. You've got a great podcast. Yeah. How can they connect and watch and be a part of what you do?
Sure. So my podcast is called Achieve Wealth Through Value Real Estate Investing Podcast. It was voted a top 24 real estate podcasts for 2019 and top 50 commercial real estate podcasts. So it's called Achieve Wealth Through Value Real Estate Investing Podcast. I have my own book. It's called Passive Investing in Commercial Real Estate. So whoever want to look at the world of syndication from a passive investor standpoint should definitely check out that book. It's called Commercial Investing in Real Estate, Passive Investing in Commercial Real Estate, right? The Insider Secrets to Financial Independence. This is on Amazon. I'm all over the internet. I have my own Facebook group. It's almost 5,000 people. It's called Multifamily Investors Group, and I'm in LinkedIn. And I have my own mentoring program as well for people who want to get started in this business to be active. And I'm going to be launching a passive investing course as well, because I think you really have to look from passive investor standpoint to appreciate the world of syndication, and there's just not many courses and resources out there for passive investors.
Yeah, absolutely. Well, thank you so much, James. You've been a wealth of information and knowledge today. Thank you for your friendship, and thank you for leading the industry as a multifamily syndicator. And I love what you're doing. I've enjoyed getting to know you and your wife over the past year. But thank you so much. I appreciate it, and I hope you have a great day today.
Yeah. Thank you for having me, Eddie. It was really nice to be on your show.
Awesome. Thanks, James. Think Realty Video Podcast viewers, thank you so much for watching. We appreciate your time today. As always, I hope that we brought you good value and brought a great connection to you. If you don't know James and you haven't seen him in the past, make sure you go and watch his podcast, listen to it, and take part in what he is doing. If you are in the multifamily space, his Facebook group is a very big group that with a wealth of information and knowledge. You have to request the opportunity to be on there, but it's something that it would be worth your time. But I would encourage you to go and to follow him, to all of our Think Realty viewers. If you are watching today, again, I want to say thank you to our podcast sponsor. Another one of our sponsors is Aaron Chapman. You can go to aaronbchapman.com. You can bypass all the overcomplications of the common suit and tie mortgage guy and connect with Aaron Chapman and his team of real estate investment finance experts at Security National Mortgage. No fluff, no complicated industry speak, just brutally direct action. Visit aaronbchapman.com today for more information. That's Aaron B. Chapman. Aaron is a great conventional lender. He's worked with me on projects, and I'm sure him and his team will take care of you. Thank you again so much for watching. Again, a quick thank you to our the first podcast sponsor, Clint Coons and Anderson Business Advisors. They do a great work as well. If you are watching and you haven't already seen our latest post on social, that's probably because you're not connected with us, and we want you to be connected with us. We're everywhere where you are. So if you're on LinkedIn, Instagram, Facebook, we're there as well, providing you great information. If you haven't read the latest digital version of the magazine, go to thinkrealty.com and download the latest digital version of the magazine. You can also subscribe and have it delivered to your doorstep, or you can go to the latest, to the local Barnes & Noble and pick up a physical copy off the shelves of Barnes & Noble there as well. Thank you so much for watching. Have a great day. Happy investing.